Hello, welcome to PlanAssist. Today we're going to interview a expert in mortgages in which comes with debt. And so, as you know, PlanAssist has three primary principles. Let's have a plan, be diversified, and seek counsel. Today we're going to specifically talk primarily about the have a plan and the seek counsel. So it's not so much the diversification, but if you're going to buy a house in the next 6 months, year, 18 months, put a strategy together on how do you have your best chance of getting the lowest interest rate possible in 12, 16, 18 months. And some of the stuff that Chris will actually share with us today will help you with that. And second is the seeking counsel means having a conversation, not just with your real estate broker or just with your new mortgage broker, but a variety of different sources. So you kind of understand best case, worst case scenario. What are some of the things you're going to run into when it comes to a mortgage? What's the best one to get? And just some of the key metrics that will have an impact on both getting you the best mortgage possible, but also getting it paid off and or some of the events that'll come up. So whether it's fixed or variable, that will make a big difference. And how you can afford it, and then what house you can buy and what neighborhoods and all those kinds of things. So with that, I'm going to get into the podcast, and I look forward to having you like and subscribe so that as time goes, you get more and more of these videos. Thank you very much and have a great day. Hi, everyone, and welcome to PlanAssist Podcast. As you know, in PlanAssist Podcast, we interview people who are successful or experts in a particular field to help you either maintain your wealth or grow your wealth. And we do it around three primary principles: have a plan, be diversified, and seek counsel. And each one of those, though they sound really simple, they become really complicated, and they need to be very specific to you. That's the reason general advice typically doesn't work. Today we have a great guest. That's someone who's been in the mortgage business and loan business for more than a decade, and I can't wait to hear how he kind of helps us with that debt part of it. But I think you'll see this theme of have a plan, be diversified, and seek counsel kind of throughout this podcast, but also throughout the other podcasts. So with that, today we have Chris Koss as our guest. Chris has been in the mortgage business and the finance business for more than a decade. He also does his own podcast, so on different subjects, not necessarily the mortgage. So we can touch on that as well. I think you'll get. I think we're going to have a really, really fun conversation. I hope you enjoy it. And if you do, obviously give us a like and a subscribe too, so you see more and more of these. So with that, Chris, did I miss anything?
No. I think you're dead on as usual.
Uh, Awesome. Okay, so as you know, and I've even talked to you about this, Chris. This podcast is all about starting with that kind of first question. So, if you could go back and give your younger self financial advice, what would it be?
Never get married. No, I'm just kidding. I'm teasing. I'm just teasing. Divorce is expensive. Just kidding though. Patience. Like I think as I look back to it, like when I was in my early 20s, like I wanted as much as possible, as fast as possible, and then maybe wasn't as risk averse as I should have been. So I would say like you don't realize, like I think people underestimate what they can do in a year and overestimate what they can do in a week. So if you just are a little bit more patient with yourself in like growing your wealth and your with experts like yourself, I think that's where I would have picked up a lot more traction in my early years as opposed to figuring it out in my later years.
So to expand on two comments that you just made, I'm going to do the last one first, the patience piece. That is absolutely critical, I think, from building business. And in our business, we're even farther. We even have a longer runway than you did. You talked about a year and a week. We talk about you overestimate what you can do in a year and underestimate what you can do in a decade. Like, so
There you
my
go.
world thinks in terms of decades.
Yeah. Yeah. I mean, I think it's just, I mean, it's human nature, instant gratification society. I mean, we're all watching YouTube videos based on 2 minute segments as opposed to watching 30-minute Family Ties programs like you and I probably did when we were growing up. So it's a matter of watching that slow, awesome build, and then as it builds, you see it exponentially get bigger and bigger, even at a faster rate. But everyone wants it like yesterday, I guess, and that's where I kind of like. You and I, when we initially met, I think I was telling you that I put part of my down payment on a house was from trips to Vegas. That was not the way to go. That was not the wise investment plan. That was the instant gratification plan. That is the exception, not the rule.
Okay, so patience is a good one. The second one is, and though I know you said you were kidding, getting married. If I look at my clients who have accumulated kind of seven-figure net worths, or people who haven't, I do think what you said is the two really big obstacles to that is marriage and partying.
Sure.
It's the drinking and I mean, the person who does hardly any drinking and hardly partying and stays married to one person their whole lives will almost always end up with a seven-figure net worth versus the other person.
Right, right. And like, I don't know how often you see it, but I feel like that's more of a unicorn than anything. Like, divorces just so high. And look, happily ever after is beautiful and amazing, and I cheer for it for everybody every day. I really do. And if that can work out and goals are aligned and everything goes well, then that's perfect. But if it doesn't, I can't tell you just how many times in my world I spend looking at divorce decrees where there's equity payouts from properties or 401ks, and just life happens, and it's
It's
just sometimes
yeah,
hard to
and
overcome that.
well, and it's devastating financially because
Yeah,
all of a sudden you have two households, two sets of expenses, two house payments. Everything becomes duped, and
yeah, yeah.
sometimes the income just isn't there to support it.
And untangling is hard too. Just separating bills, separating the child support, alimony, depending on where that goes. Like just things you like, you wake up in your 20s, you're not going, gosh, I know in my 40s, I can't wait to pay child support. That's just not on anybody's bingo card, but it ends up showing up on so many.
Yeah. So let's get into your experience as a mortgage person, both as a broker, as a person who's helped and given lots of feedback and advice. Um, Over the years, what do you think some of the smartest moves you've seen clients make? Like as they're, when you look back and you're doing a mortgage and it goes relatively smooth, what's some common attributes?
So the number one thing that I truly believe is the best mortgage is no mortgage. That way, like if that's the best interest rate, the best way you can go. So the bigger like the patience, again, we'll go back to that. If you can find a way to put as much money down as possible, which it's tough in this environment. Eggs cost more money now than a gallon of gas, it seems like. So it's tough, but if you can bring that down, I think that's always the biggest move that anybody can make. Like everybody is so quick to rush to get into a house, and they won't have as much down payment, they won't have as high as a credit score as they can. But if you can do anything to get those in the optimal place, that's perfect. And don't be afraid. Like right now, it's a really high rate environment. It's been that way for about 3 years, and it may start trickling down soon. Um, just a lot of people are really afraid of, and don't punch me for this, but adjustable rate mortgages. And those really ruined, I guess, the economy quite a few years ago, but they've changed so much. Like one thing with an adjustable rate mortgage is you can get a lower interest rate than what the current market rate is, and it's fixed for the first 3 years, 5 years, or 7 years. So you're getting a lower interest rate for that first three, 5, or 7. That might save people. That usually saves people quite a bit of money, and then as interest rates dip down, you just refinance into a locked in interest rate at that price. But in the meantime, you're saving yourself possibly 2 or 3%, or even going through a builder is a good way to go too, because you can get a lot of lower interest rates as far as that goes. Those are some good things I see people do that save themselves money over time. Just jumping in too quick, getting a higher interest rate, that's just going to change your entire lifestyle as far as what you can afford.
In mistakes, do you see I'll just comment on something that I see happen with some of my counterparts is they just stay in too big of a home. The contentment,
Hmm.
it's not that they can't buy a home, but why do they have to buy a home in this neighborhood? I mean, they just barely will get in, and real estate brokers are the worst at helping us get into homes that we really can't necessarily afford, or we can barely afford. It's maybe a better way to word it.
I love you so much for saying that. Because it just shows how genuine you are about looking out for people. Um, you know my ex-wife, and I love her to death, even though I made the joke in the beginning. When
Right.
we bought our first house, or when we bought our house, it was 2005, and I remember we went in and they wanted to put us in, a house that there's no business we had being in. Like it would have foreclosed within 2 years, I'm sure, because they didn't care about debt to income ratios. Like the rules weren't the same as they are now. They pretty much just could write anything on paper and qualify you, and they can't do that anymore. Now, you're right. Now it seems like there's so much keeping up with the Joneses. Like it really is. Like I want the nicest house on the block as opposed to I want the biggest bank account on the block. Like it just seems like I just want to show how much I have instead of just be quiet and, live a more comfortable life.
And that shows in two things, house and car.
Yeah,
Right.
totally.
I mean,
Totally.
those are your
Totally.
two places. And I'll bet when you're doing mortgages, those are your two problem children, right? I mean, when you look at when you're trying to get someone pre-approved or get approved for taking over a loan, et cetera.
100%. Like I can't tell you how many times I'll pull credit on somebody and there's a $900 to $1,100 car payment, and I'm like,
Yeah.
that's sometimes it's even more than some of the, well, it's definitely more than some of the house payments that I see. I mean, that thing better come with a full bathroom, a shower, and like, just a porta potty or something, because that's a beautiful automobile. Yeah, in like what you also don't realize too, I think that you see just as the side effect is you have this beautiful house, you have this beautiful car, maybe you're month to month, but your therapy sessions are gonna be way more than your house payment.
No, and it goes to your relationship with your significant other. I
Yeah.
mean, all of a sudden it becomes, one of the top reasons is fighting over money, right? I mean,
Totally. Totally.
I
Nobody's
mean,
happy.
so
You can't afford D. Like you're living in a nice place. What's a great movie? Cinderella Man was a great movie. With Russell Crowe, was the fighter
exactly.
back in
Oh
the
yeah, I
50s.
loved it. Yeah.
And I think he goes to his trainer's house or agent's house. I forget who it was. Knocks on this door of this beautiful place, and they open up the door, and there's just one table with one chair in there because they had to sell everything else because it was the depression and stuff. Couldn't afford anything else in the house, but outside it looked awesome, just like we're talking about. Like you walk up to it, wow, that's great, and you're sitting on lawn chairs in the living room watching a 24-inch tube TV from 1927.
So I totally agree. So I'm going to switch just 1 second, and we're going to get into some specifics. But before I do that, I would just want to point out to anyone listening to this call, having a plan, and it goes to that. I can't emphasize enough. That does not mean this 45-page PDF where you've sat down with a financial advisor and put all your information in. Da, da, da. I mean, it just means have some strategy on your expenses, your debt, where are you at now, where do you want to go, and go over the next 3 to 5 years. And it kind of summarizes a lot of the stuff Chris just talked about is in a plan, you can't afford that house 5 years from now unless you get three promotions.
And may I say this, and like definitely correct me if I'm wrong. And look, I know that sometimes my plans suck. Like I don't have the best plans, but I know if I call you, I'm gonna trust your plan better than I'm gonna trust my plan. You're gonna goal align with me. You're gonna say, all right, you're like you every time we talk, all right, what are you looking to do? What do we need? How do we need to set this up? And I know that my best plan is to listen to your plan with my goals in it. So just because I don't come up with the best one doesn't mean you don't know somebody who has a better one and use that one.
And more, and as important as what you just said is, and you know this from working with me, I don't ever say no. It's always yes, but okay.
Yeah, yeah,
It's not because I'm not. It's not. It's your money. You get to spend your money how you do. I'm not your babysitter or something. My job is to just point out different ways to think about options, right? And so I really work on trying to do yes, but it's in this sense of giving you information. And I get to that seeking counsel piece is it's everyone thinks of seeking counsel as sitting down with some salesperson who's selling them something and then telling them what to do. Seeking counsel means just getting input and getting a good understanding of worst case, best case scenario, right? I mean,
right.
and then you decide.
Yeah, yeah. And like every time, like it's always helpful. Puts me in the right direction, puts me in the right of, hey, here's what's coming down the line for you.
Right.
So my plan may not be the best plan, but after we talk, I feel like I have the best plan.
Good. Okay. So now let's talk about as you go through and do mortgages, and I understand you're doing a lot of assuming mortgages, so get helping
Yeah.
people with some lower rates. But there's a couple things that I hear, like when I watch YouTube or read articles, et cetera. And so I just want to get into some of the things that I just like to hear your view on them and kind of what you see that might help people before they start applying for a mortgage or as they start rebuilding their credit. So the first one is this phantom debt. Okay, so I'll bump into people who will think I even have clients who will say, I didn't know I had some credit card outstanding that's now due or da 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 da. How often do you see that, and kind of what do you suggest people do about the potential of phantom debt that'll show
You
up when
know,
they apply for a mortgage?
I don't see that too often. Like I haven't seen that, like, because one of the things I'll do is I'll review a credit report with somebody. And it does happen every now and then to where like they didn't know they had something. That's usually, yeah, I guess where I usually see it is go back to the divorce case where like an ex put them as an authorized user to bolster
Oh,
their possibility of getting approved. And even in or they just forgot about it, or drugs are bad, get off the drugs and let's just understand what's going on in front of you. So I don't see that too often. There's been very few cases of, let's just say, identity theft to where it's been like, hey, that is entirely not me. At least when I pull up the report. Now,
okay.
I've
Interesting.
seen a couple instances where it's been like, hey, I had no idea that was there. But I would say in the 10, well, I guess, gosh, time goes like that. But remember, be patient. 15 plus years, I guess, is really what I've been doing this for. I've maybe seen it a handful of times.
Okay, so it's very rare. So it's one of those
Yeah,
things we
yeah.
hear about, but it's not necessarily something people run into. A
I think it's a
co-signer
fear.
on their grandkids' accounts. I've seen that
Sure,
periodically.
sure.
And
And
then
I
they
guess
forget.
when it does happen, though, it does seems like it happens with more elderly people who are just maybe not understanding what they're getting themselves into, signing something that they just don't totally understand what they're signing with some
Okay.
capacity. Just those, like we were talking about, you were mentioning scams that possibly get into scams, like those, not necessarily total identity theft, but just taking advantage of unknowing people who have kind hearts. That just seems like that might happen a little bit more frequently from what I've seen. But
And that
I
could be a
think it's
family member a lot of times, right? I mean, it's not
and
necessarily
that
someone you don't know.
totally, totally. Like that's
So,
gosh, that's not the Brady Bunch that we're looking for. No, totally the family. Yeah. And it's unfortunate and it's not uncommon. Like there's but I don't see it in my world. I definitely hear more about it than I see it when I pull credit.
okay, so talking about pulling credit. So there's three credit bureaus, right? So when you
Uh,
pull those, what are some of the are they are they different? Is my score dramatically different on all three of them, or and then is there like a number I just kind of you've got to stay above some number, 650, whatever number.
Yeah, so
So
man, let me tell you, when people like will call in and they'll have their credit cards, will give them a credit score, all the different sites that you can go in and check your credit score, and then when we pull for a mortgage, it's always different. Like it's never what they see, and then it's almost like a therapy session on like on why that is. So when people are looking, and I promise I'll address your question, but when people are looking at their credit score on their credit card or just a free credit report or whatever it is, that's a general inquiry. People are looking at the general. But when you pull for, let's just say, a mortgage, things are weighed differently, and they're so you may
Oh,
see
interesting.
you may see 700 on yours, and then when I go to pull it, it may be 620 because certain things carry different weight. We pull all three bureaus, Equifax, TransUnion, and Experian, and there usually is a difference. It's usually about 20 to 35 points difference between the highest and the lowest, but I've seen it as much as 100 points, and that usually is because, in most cases, one bureau has cleared up an issue that another bureau has not, or just something along those lines. So there can be quite a big difference. And then when it's in the mortgage world, it's always the middle score. So it's not the highest, it's not the lowest. They kick both those out, even though they use the complete report and the trade lines, but they'll use the middle score for interest rate pricing.
And then what would be the difference in interest rates? Like if I have a 680 and a 620, what would be, and a 600, say, so they use the 620. What's the difference between interest rates on a 620 and 700?
Yeah, it's definitely, it's definitely it's definitely Cheech and Chongish. The higher, the better, right? So it's like when you right now, it's such a bad rate environment, and like 6.5% is not uncommon, and that's paying what they call discount points, which those are just prepaid. You're prepaying the interest to get a lower interest rate. A 680 score is great. Like people are too hard on themselves, I think, about credit scores. So let me give you an example. FHA, for example, does not have a minimum credit score requirement. You can be down to a 500 credit score and possibly still get an FHA loan. What happens is lenders put in what they call overlays, and they say, we're just not going to take high risk, go under 620. And that usually seems like the baseline for an FHA loan for most lenders is 620. The
Okay.
company I work for does go down to 500. The score is one thing, the credit profile is another thing. If your credit score is being dragged down because your utilization, and what I mean by utilization is the amount of credit you have available to you is low because the charges on the cards are so high. If your utilization is low and that's what's dragging the cards down, that can be worked out. If you have late payments, that's a little bit tougher to work through. Installment loans, you don't want to have any late payments on. You can kind of get by if you're late on revolving debt, credit cards, for example, if you have a late payment within the past 30 days. If you have rent or another mortgage and you've been late within the past 12 months, your likelihood is really, really low of getting anything good. So if you could be 680 or better, that would be ideal. But between 680 and let's just say 620, your interest rate is going to be exponentially higher when you get into the 620 range. But I would say a baseline of 680 would get you to a good start. And it's hard to get there. Like
Yeah,
people are
that's it.
really too hard on themselves.
Well, then they go hire these credit bureaus or these people that say they can raise their credits. Does that work?
Not so some do. So there's a stupid little trick that if you go to optoutprescreen.com, OPT outprescreen.com, you register your information, give it about 30 days. Now, what this will do is it'll take you out of any random solicitation to where they say, hey, you've been pre-approved for this card. And it'll take you out of that. And that could raise your credit score 10, 15, 20 points in the next 30 days, just depending on where your credit score is at. If you're already a 700 score, it probably won't. But if you're a 500 score, that's an easy way just to get your score raised just by doing that. Some of the places, though, like credit repair companies or debt settlement companies, they're not going to do anything for you as far as your credit score goes. They might help you get out of debt quicker, but what they're going to do is they're going to treat you like you're a Las Vegas hotel. They're going to implode you and bring you all the way to the ground, but then you'll rebuild faster because you're out of debt, you're done with debt, you're good to go, and you're building yourself back up with new credit cards and better utilization.
But to do that, you got to be mentally prepared. That's like
Yeah,
getting
that's true. I don't
that's
recommend it. Don't get me
that's like
wrong.
going out and getting in shape. I want to go do a marathon. That's fine, but you have to mentally say, okay, that means I'm going to do the training programs, and that's not some fix it in a week thing. That's
No, not at all. That's a 3 to 5 year thing in a lot of
okay.
cases. we're possibly quicker. And all they do, and I'd never recommend them. Don't get me wrong. They're out there. Some people need them. Um, so they're out there for a reason. But you pay into an account. They stop paying your credit cards. They stop doing all that stuff. Um, and then once you're behind, it's a weird, and you can speak to this, I'm sure, way better than I can, but it's a weird thing that you live in to where you only get help when you're behind. When you're struggling and you're kind of just barely making it and you need help then, they got to wait till you're 2 or 3 months behind before they're like, okay, now we'll help you out. And that's what happens with credit cards, mortgage modifications, and things like that.
So just, yeah.
Yeah, it's like, hey, okay, they're drowning.
Wow.
We'll see what we can do. But then they'll put stuff back on the back end. So it's they'll negotiate the interest being gone. They'll negotiate all that. But in my world with mortgages, it's always like it sounds. I know it sounds so remedial, but the more money you have down, the better your credit score, the better you're going to be. But if you're not in those cases, I promise there's still good things for you. Because rent's expensive too now.
Yeah, no, that's right.
It's
So,
tough, but stay in your means, like you said.
so then, one of the things that I recommend everyone do. So I have like a little article, whenever people talk about like getting scammed or fraud or something like that's a big part of my world. And
Yeah.
I always recommend people do three things. I recommend that I'll give you the three, and then you comment on if you think those are right. And trust me, you don't hurt my feelings if you don't like them. But number one is I freeze all my credits, right? So all three credit bureaus I have frozen. Pain because then I have to go on it. If I ever go get a loan or add a credit card, I have to unfreeze it and bring it back on. But people can't do much if you can't get a credit check, right? So I freeze the credit. Number two is I get a IRS PIN number, which takes
Mhm.
no time to do. They give you a 4-digit PIN. They update it every single year to process your taxes, so no one can steal your tax return. Basically, is what that does, and it's again a little bit of work, but free. Doesn't cost anything. And then the last is you do pay for someone to monitor. So it's a LifeLock or something like that that is monitoring. So I really highly suggest people do that. What's like your sense on those three things? Do you disagree, agree?
My credit is frozen. I have well, I think two. I should get all three. I need to do LifeLock. I've thought about that for a long time.
But you
So I
do have
probably need
credit
to.
frozen, so you do the
Yeah,
credit froze.
yeah.
Okay.
Yeah, and like I love them because like yes, it's an inconvenience. Although like with the apps and stuff, freezing and unfreezing your credit isn't hard to do as it used to be. It used to be a real pain. The
Right.
PIN number I need to look into, so I just took notes on what you said. So I need to do that. But even though these may be a little bit more challenging, like and again, not as bad as they were, boy, it's so much harder when somebody gets your identity and starts charging stuff up to get away from that. Like that's almost impossible, it feels like.
Oh my gosh, it's just so difficult when it happens,
Yeah.
and it's so just feels so invaded. I mean, not only
Yeah.
the pain of it, but it's just oh my gosh, it's a rough. So, anyways, all right. So then,
Trust. I wouldn't have any trust for anything anymore. Like I'd carry all cash and not everybody takes cash anymore.
exactly, you can't even rent a car for God's sakes.
Yeah. Yeah.
Yeah,
Yeah.
I mean, you
Totally.
can't. Yeah. Okay,
Totally.
so last two, and you can just kind of build on these two things. Kind of bankruptcy and student loans, we can just kind of pile into the last kind of conversation we had. You can kind of compare them. Obviously, you can't get rid of student loans. There's a lot of news about student loans because the government's now starting to seize people's credits or uh, take their paychecks, etc. Kind of what's your I guess before I get to there, those are general, but here's the specific. Is it true where they say when I go apply for a loan, I get myself, financially in line because that's really who you're for. The person who's really struggling clear at the end needs Dave Ramsey, right? So this goes
Absolutely.
to
Yeah. Totally.
specific
Yeah.
advice. So talking to the people who are getting ready to buy a house, et cetera, if they had a bankruptcy, what, 7 years, 10 years, does it not show up at all, or does it show up and ding me?
No, it won't ding you. It shows up. It shows up. Like when you pull credit, it'll show two things. It'll show the file date and the discharge date. So if it's been 7 years. Like it's just going to show up on there, but it's not going to drag your score down like it would if it was a year ago.
Okay.
So bankruptcies they'll be okay. And I think if I remember right, it depends on the chapter. Chapter 7, I believe you can do an FHA loan after 2 years. Chapter 13, you can actually file a Chapter 13 bankruptcy. Start as long as you've made, I think it's three payments onto what your repayment is with the Chapter 13. As long as you have an okay from the court, you possibly, could move forward with a mortgage loan. But in most cases, and that's FHA loans. Conventional loans are longer than that, and VA loans are 4 years, I think, 4 years, and then the same with the Chapter 13. So your score is going to stink, but it doesn't mean you're out of the running.
The closer you get to the 7 years, it gets better and better. Correct. I mean, it's not like
Yeah,
it's not like bad, 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 and in 7 years gets good. It's more just gradually gets better the
yeah,
closer you get to
yeah.
this. Okay.
Exactly. And the 7 years is really just like totally removing from the credit report. Again, you can do this after 4 years and move forward. You don't have to wait 7 years to be like, all right, I filed bankruptcy. I can't get a mortgage for another stuff. That's not true at all. So you could possibly do it in 2 to 4 years. Because like the thing about bankruptcy too, and again, you know this better than I do, but once you claim a Chapter 7, I think one of the first things you get in the mail is an application for a credit card because you can't claim bankruptcy again for another couple years. So creditors are going to want to come like get you. So they're like, hey, cool. All right. We know you can't write this off.
Yeah, that's a good point.
Right. So
So then student loans, do you see that as a big deal? Like, especially people have kind of gotten themselves financially in a pretty good place. They're buying a house, they're saving, they got a 401k, and that student loans just kind of hanging over the top of them. Do you see that or not so much?
So there's a lot of weird things. Weird student loans have their own like they're their own Goonies movie. I mean, they're just like I feel like they need Sloth with his Superman shirt, going on with his baby Ruth. And so the way, let's just say I have $100,000 in student loans, or you have $100,000 in student loans, and I go pull your credit. It's done now mainly through ED Financial, Education Financial Services. When we pull them, it doesn't show up as one trade line for $100,000. It shows up like 18 different trade lines for whatever reason it breaks it down. Now, most student loans are in deferment, but when people get mortgage loans, what they don't realize, they're like, oh, it's in deferment, no big deal. But at some point over the next 30 years, if you do a 30-year loan, those are going to come out of deferment. They might get forgiven, they might get not, but mortgages are always going to be worst case scenario. So if you do an FHA loan, for example, they're going to take 0.5% of your loan balance in student loans, and that's going to be your repayment and factored into your debt to income ratio. So that can be a very high percentage of somebody who might, be a doctor and owe $150,000 in student loans and can ruin somebody's opportunity to get a home for their debt to income ratio. So what they have to do is contact ED Financial, and even though it's in deferment, ask them, hey, what is my repayment going to look like when this is out of deferment? And they'll give you your minimum monthly payment, and it's always less than what the mortgage lender has to use for their automatic calculations. And once you get that, they should be able to use that. That'll help your debt to income ratio. That's for FHA loans. Conventional loans are a little bit higher, but VA loans, if they're deferred for a year or more, like if I pull the credit report, it'll say on the credit report how long they're deferred. And if I see that your student loans are in deferment until, let's just say, January of 2027, I don't have to use a repayment for that at all. So it just depends on what type of loan, what scenario, and how that kind of shakes itself out. That's the biggest thing I see with student loans is how they affect people's debt to income ratio.
Okay, cool. Awesome. All
Yeah,
right. Well,
it's no fun.
yeah, exactly. And it's always something. And this, it goes back to again, this isn't for that person who's completely in debt. These are the kinds of things that people who are just doing a really good job, living life, they're living, and they're just going to bump into these things periodically. And kind of what do you do about that, or how common is it? So I appreciate that. So with that,
Sure.
before I give kind of just a Pierce summary close, why don't you tell me a little bit about yourself and kind of your podcast? So what would be some of the stuff that you cover on your podcast? And
So I should have switched the background. So I record through Zoom, and this is just what automatically comes up. Obviously, I do this. It's called Swipe Wrong. It's just people's dating experiences when they're out there trying to figure their personal side out as opposed to their financial side out of what we're talking
Which
about.
are together. I mean,
That's true.
I
That's
mean,
true. So I hear people's stories when they're on, I don't know, first dates, second dates, third dates, and what I hear on those. So Swipe Wrong, it's on YouTube. It's pretty much everywhere. We've been doing it for about 4 years now, or 3 years now. Some people really look out for each other, and some people really do not look out for each other.
right.
So just like in finances, you have red flags just like you do on dates. So that's what I do, and that's why you see the background that you see. Other than that, my other life is mortgages and podcasting. That's all I really do. It's a good time.
It's awesome.
And when I run into the issue, it's, hey Tim, what do I do here? And Tim's like, yeah, I got you, bro. I got you. Thank goodness for that.
Well, I can't tell you how much I appreciate you because as you guys listening to mine know that I'm really just getting started. So Chris and I had a conversation last week and he gave me some suggestions and ideas on how to kind of grow this because my goal is to find a group of people that I can actually help really maintain or grow wealth and answer some of those questions that aren't always directly answered is a way to kind of think about it. So how do I help that group think about?
I can tell you this, like I made the joke, and I'm sorry I don't mean to interrupt, but I made the joke about don't get married and ex-wife, but I can say my ex is still like my best friend, and one of the best things she did is link me up with you. I'm very grateful.
No, but again, from a podcast, you said make podcasts for real, make them real, right? That is
Yeah.
the real thing. That's what people are dealing with. I mean, they're dealing with, addictions, they're dealing with, relationships, they're dealing with, what do you do here? What do you do there? And all that applies to finances and money, to be honest with you, or I think that they ultimately do.
I feel like people, and honestly, I see it through their personal, like their struggles with dating and relationships, and I'm sure you catch wind of it in the conversations you have. We're all so hard on ourselves. Like I get the phrase I like to use is be your biggest fan, not your biggest critic. And if people can fall into that category, because the rest of the world's got enough time to say all the bad things that you might be doing, and they have no idea your whole story and what you've been through or anything like that. They can go friend themselves and have a nice day. Like it doesn't matter. Just be your biggest fan because you've overcome 100% of your worst days so far, and you're gonna keep doing it. So there's my talisman spin on it.
That's an awesome way to finish the call. So again, thank you guys. Thanks for joining. If you want more information on PlanAssist, it's planassist.com is the website. Swipe Wrong is Chris's website and YouTube channel. So if you have any questions, feel free to go to any of those. And we'd love your comments in the YouTube. I mean, whatever you're thinking, we appreciate your feedback and input because I do read them and I do want to get better at providing more and more for people. So with that, do you have anything to finish on, Chris?
No, thanks for having me, bud. I had a great time.
Thanks again. Okay, I appreciate you. I really appreciate you jumping on. Thanks again, Chris.
Anytime.